in word format form where I basically explain these setups right here. These four are basically how I make my money. And if you think about it, in terms of supply and demand and just why the market moves, I mean, the market either moves up or down for one of two reasons, and it moves sideways for one of two reasons. You get movement in the market because you have an imbalance in price. So what that means is that you basically have more buyers and sellers if the market's going to go up. And if the market's selling off, you obviously have an excess amount of supply and not enough demand to support bids. And if the market is chopping sideways, that means you have price in agreement, like equilibrium. So basically, you have a lot of liquidity there, and basically price is going to stay in agreement until there is an imbalance created. So until there are more buyers and sellers, or until there are more sellers and buyers. So let's jump into it, all right? So these four are the main structures that I look for. First, starting on the left side, we have a rally base rally. This setup right here forms in uptrends in bullish markets. And the idea here is you want to get long on a retracement back to demand. So what this means is that you have the market going up and up and up. You know, the market's going to go up, it's going to pull back. And then what you want to do is you want to get long on a retracement to demand. What this doji right here represents, the base, this is called a rally base rally. The demand resides in this basing candle right here. Let me turn this yellow. Okay, so that's where the demand resides, because if you guys think about it, the market rallied, okay, and then it paused for a second, okay? So the market has accumulation and distribution phases. So the market was able to rally, and it paused for a little bit, and then it was able to rally again, okay? So what that tells me is that you have accumulation at this base right here, because remember what I said, you know, market only moves up or down because demand over supply or supply over demand. So at this base right here, I know, judging by candle structure and on the higher time frames, that this is a high probable area to get long at, because you basically have price took off at this basing level because there was too much demand. Okay, so what happens is that price basically moved up too fast for them to fill all their buy orders, because it was an illiquid area, which is what caused the big green candle. So basically, what I do is I draw my level like this. Okay, so at the basing candle, I take the open of the bearish candle. So I take this open right here. So I take the open of the red candle, and I take my line, and I draw a box from the open to the lows. Okay, so this is basically my setup right here. So, sorry. So I take it from the open of this bearish candle, and I draw it to the lows. And my plan is basically the market's going to move up, and I will be patient, and I will wait for it to pull down for liquidity reasons. I'll wait for it to get yanked down back into demand, because the market is a game of liquidity. It's going to go to where the orders are. And this is a very high probable trade because of the setup. And if it's obviously, you know, if you find the setup on the daily chart, it's very possible. And I will show you guys on Snap a second one example of this setup working very well. So I would take this fresh level, and I would anticipate the market to pop out because of the pent up demand that resulted in the formation of this rally base rally imbalance. So again, I take the open of the bearish candle prior to the rally in price. So here's the open, and I just take my box to the open. It's very subjective, you know. Sometimes this candle can be a green candle, but basically dojis are very, very strong candles patterns to pay attention for, because when you see this sort of rally-based rally structure, the demand resides right here. So I take the open, take it here, and I extend it out to the lows, and my stop loss would probably be a little bit below the wick low here, maybe somewhere here. Again, it's all up to your risk, but that's basically where my stop would be. So that's a rally-based rally candle structure right here. And let me show you guys an example. Okay, so again, this works in all time frames, commodities, futures, equities, you name it. It basically is an analysis of price, and the theory behind it is that price only moves for one reason. So if you get these sort of candle structures to form, it's very powerful because the market only moves for one of two reasons. Okay, so what you guys just learned right there, look at what I found right here, okay? You get a rally, and then you get this base right here, and you get another rally. You get a rally base, and you get like another rally upwards. So in this instance, remember, you have to always look left. Look left and then trade the white space to the right. So here I would put my horizontal ray at the open of this basing candle right here. So it would go right there at the open of, let's call it $13. And then so that's my proximal line, and the distal line would go to the wick lows. Sorry, I would go to right there. And then I would just simply zoom out, and I would draw my box here. And this is my demand zone right here, okay? And it's fresh. Remember, it was fresh until the market pulled into it. So you get all this price action here, market moves up, chops around, and then you get the sell-off back into demand for liquidity reasons. Remember, market sells back, off, sells, and then look at what happens, guys. It gets pulled right into demand precisely in this level that I mentioned right here, and you get a huge rally. Why? Because the market got overextended from 13 all the way up to 1840, and there's just no demand up there. And judging by this candle structure and just how the candles are formed in this level right here, I could tell you that there was a lot of pent-up demand, and this is a very powerful candle structure. If you see this on a daily or weekly or 4-hour chart, fresh levels are very, very, very high probable setups. So look what happens here. You get the sell-off, and look what happens. The wicks represent like an effort to sell or to pick up orders, all right? So if we know that, judging by my analysis right there, that this is a high probable level based on the candle structure, the market comes into demand right here, picks up those buy orders that did not get filled here. What do I mean by that? At this level right here, where it formed that rally base rally. Let me just so you guys can see for visual purposes. Rally base. One second. Rally base rally. All right, so right at that basing candle where this red doji is right here, rally base rally, that's where the demand resides. Look at how fast price left that level. You see that? It rallied, paused, and it exploded up. So that tells me that you had a surplus of buy orders waiting right here at this zone because price took off too fast for the institutions and for the big boys to fill their buy orders. So what happens is you get the market to move up, and then you get manipulation lower back into the demand zone. And the orders that did not fill originally when that imbalance was created, those buy orders hit the market right here when the market sells off at that price point. So the market sells off, and look at what happens right from that level. You get a huge rally from that rally base rally demand zone. And then you get the basing candle right here, this little red doji sandwich right here. You get this red basing candle, and then you get another huge rally out of it. So this little area, this little basing candle right here is very powerful. So it's powerful because of how fast price left this price point right here. It's powerful because price did not last very long here, which tells me that there is a lot of pent up demand there. I can go back and I can show you other levels of demand, that are low qualities, but again, you want to focus on higher time frames. I mean, just looking up here, you have, here's another setup. You have a rally, base, and a drop. Like I say, how the market likes to always come back to the origin of a moving price. to basically fill those orders that did not fill originally on the original sell. So in this instance right here by this pivot high, let's call it 1836, the market was moving up very strong, right, from this level of demand right here. You know, we had a huge rally out of it, and then we saw sellers begin to step into the market. So from 1836, they were able to push price down from 1836 all the way down to 1450. So for the market to be rallying really hard from down here from 13 all the way up to 1840, and then all of a sudden it bases right here, and for it to sell down that viciously and that fast, that tells me that, hey, you know what, there must be a lot of supply there for it to basically reverse the market and for it to turn on a blink of an eye like that. So that leads me to describe and explain my next setup, which is a rally base drop. Rally base drop. These are bearish setups and reversal patterns that form, and this is a very powerful structure when it's printed on a higher time frame, such as 2 hour, 4 hour, daily, and especially weekly. So what I do here is you get the rally base drop, and it's the same thing for what I did with the rally base rally. I look for the open, or I look at the body of the basing candle before price sold off. So in this case, I could draw my box starting from the wick low here, or at right here at the body of the basing candle. So I draw it at this level here, and I would extend it up to the wick highs. And my stop loss would be a little bit above the wick highs, so somewhere, I don't know, somewhere around here. Remember, it's all relative to your risk. So with this setup, you want to be patient with it. Price is going to, sell down. It's going to go up, down, and then eventually you're going to get a move back to the origin of the sell. Because remember, the market always likes to make its move back to the origin of a move in price. So I would wait for the market to move back up into supply here. And this makes a very high probable trade for the short side, because if this structure can print on like a daily or weekly chart, it's very powerful, and I would take the short up I would take the short trade every single time, as long as it's a fresh move into the level, meaning that this is the first touch into the level of supply. So if this was tested multiple times and price came down here, tested it again, I wouldn't take the trade because it's no longer fresh. I would only take it on the first tap, because that's going to be your most explosive and stronger reactions. But anyways, I would look to short it, and I would expect price to make its move back down to demand. So knowing what I just explained to you guys there, here is a clear setup right here. I'm going to go over it again. So from the rally base rally imbalance, it took off, right? And look what happened, guys. It sold off from 1830 to 1450, forming supply. You get the rally base drop. You get the rally, you get the base, and then you get the drop. So how I would draw my level here is I would look, and this is the origin of the sell, right? So what I would do is I would do exactly what I told you guys up there. I would look at the basing candle before the sell-off. That would be this green candle right here. So I would take the open of that candle right there, and I would extend my box from the open to the wick highs. And my stop loss would be, remember, a little bit above the high. So let's call it, I don't know, 1860 maybe. It just depends on your risk. So that would be my stop loss right here. Let me stop. So that'd be my stop loss right here. And I would look for the market to make its way back up into that supply zone, and I would look for a short trade. So again, we sold off very hard from this origin of the move here. We sold off. So right away, I know that there is a lot of pent up supply there for it to reverse price that fast and that sudden. So we get the sell off, and then we get the manipulation higher right here. We get the little, we get that pivot low to form. And then the market rallies up into supply, into the origin of the sell. And look what happens. You get the overshoot, and this represents sell orders hitting the markets. in this fresh level. And then look at where price sells off to again. It's going to sell off to a fresh imbalance. So obviously, at this point in time, we did not know. So if we're looking, from behind, this this was still a fresh imbalance, and it was one of the stronger ones. And if you notice, the market made its move from supply to demand. There are some smaller time frame level of demands here, like there's demand zone here that worked, but it's not quality because look at all this congestion here. See this? Sorry, this is all congestion here, guys. This is not quality. That's all congestion. This is not quality. Look at the difference between this demand right here, and then look at the difference between this demand right there. You get no cluster of candles here. So obviously the demand here is going to be way more powerful than the demand that's in this cluster of candles here. So nonetheless, we get the market to form supply above at the 1770 area. We get the move up, form supply here. We get the move down, and then you get the manipulation up to the fresh supply zone here. And then the market makes its move back down to demand here, and then from at that point, we get a move up. So in the future, if Snap ever makes its way back up to the $20 level, I'll be looking to take a short up in here, obviously. When I talk about fresh level, guys, this is exactly what I'm talking about. So let's look left at this imbalance, the rally-based rally imbalance that I explained earlier right here. Look at the original reaction here on a fresh zone. And now look at the market coming in to test it one more time here. This could bounce. It's not going to sustain though. Why? Because all of the demand that filled on this test is most likely filled because they took price up from $12.70 all the way up to all-time highs up to nearly $20. So this demand right here, this was a fresh touch. I would take it every time. This second test here, you could see that they filled a little bit more buy orders here, but look at the volume. Look at the volume here. Look at how minimal it is. Look at the volume when it happened on a fresh touch in this zone. Look at the volume now. Look at down there. Massive institutional activity. Why? Because you have, think about it, you have the market is selling off after a big drop in price. So you have market participants selling after a big drop in price into a level of demand. Every buyer, there's a seller. Every seller, there's a buyer. The big boys suck up buy orders at this level while the other side is selling to them. And once there's no more supply for them to suck up, you get this massive reversal in this level. So this is what I talk about when I say that at the origin of the imbalance, you get little volume activity, because it is a very illiquid area, meaning that all the orders are on the buy side. So over here, you get minimal volume activity. On the sell-off into that imbalance, you get the massive institutional activity and that's representative of the elevated volume, because you have, because the big boys, they can actually fill their orders because you have the market panic selling to them, and they take advantage of that and they buy it up because they need to have people panic sell to them in order to fill their massive buy orders. Takes it up, and then look at the difference in volume now that we entered a level that was tested already. The majority of the demand is already filled, and they obviously sold up here to form that pivot high. So obviously up here, there's going to be a lot of pent up supply, and I would obviously be looking for a short position in the future. So that is another setup. And again, this works in all time frames. I could show you on a weekly chart how this would function. I could tell you why it sold off. So for example, here's another example right here. You get the market selling, formed a minor pivot low here, and then it's rallied up again. And then we get a rejection, right? So for price to move from $11.28 and to rally all the way up to $21 and to viciously make a strong move down, that tells me that there is a lot of pent up supply at this level. That's why pivot highs and pivot lows are very important, because they represent areas where the banks and institutions are buying, selling, or taking profit or reloading. So judging by this action for the market to reverse down from 21 all the way back down to $5 tells me that there is a lot of supply. So that's why if you look on higher time frames, pivot highs and pivot lows are very, very useful tools. And again, it's the same way how I draw it. You get a rally, base, drop. Now how I would draw this is I would take the open of the candle prior to the drop. So over here, you don't really have the structure, but you could still take the open of this bullish candle here and draw it right here at the open. You could draw it from there, and then you could extend your box to the highs. So this is a rally base drop demand zone. You could extend it out to there. Let me get my drawings out of the way. 1 second. Wow, way too many buttons. 1 second, guys. Delete these buttons here. All my made up candles that I drew here. Okay, same instance, guys. This was a pivot high formed by the banks taking profit here and selling. So again, rally base drop, and the origin of the sell is right here at the rally base drop imbalance. And you get the market to sell off, and then you get the relief rally back into supply right there. And we actually hit it almost perfectly. You know, you get the market to relief rally into this level here. You get a lot of people who are bullish on Snap, and they are buying the dip, and little do they know that they are literally buying into a major level of supply here where the guys are selling, because at this price point, the market sold off way too fast for them to execute their sell orders. So you still have a surplus of sellers waiting here because it's a fresh level at the time. Market pulls up into it, and you get the sell-off going down here. And it sold off into a used up level of demand. So the idea is that the market's going to break this used up level of demand, which was this was the rally based rally imbalance. You can't see it now because we're on a weekly chart. But it's most likely going to make its way down to the next level of demand. And the strongest level of demand comes from the origin of a moving price. So obviously this is the origin of the rally. And again, it becomes very subjective, but I would just take the open of the candle before the rally in price, and I would just draw my box here. I mean, I'm sure I can go into a smaller time frame and then show you guys precisely where the imbalance is, but you know, I'm not going to worry about saving 20-30 cents of my risk here, because this is a no-brainer here. If Snap ever makes its way back down to this level, I'll be going heavy long. But for example, you know, I'm gonna draw you guys a couple of fresh imbalances here. I mean, here's another rally base rally right here. You got a rally, base, rally. So here is the base and candle right here. Let me just put some letters. Rally, base. Rally, base, rally. And you can see that price forms demand here, and you get the little rally out of that demand zone, and then you get the manipulated sell back into demand to fill their buy orders. It didn't fill on the first touch because price took off too fast. It sells back into here, creates this wick right here, which represents buy orders filling the market, and then it continues to take off. So that's a rally-based rally imbalance here, and I would not be looking to get long on this level because it is obviously not fresh. So I would wait and look for a fresh zone. But here's another example of it working. Rally-based rally, And again, guys, it works on all time frames. It obviously holds more significance on a higher time frame, but you know, if I went into a daily chart, I could show you guys many imbalances. I mean, so here's a rally base rally, get a rally, and then you get that consolidation before the gap up, rally base rally. So here I would again draw my demand from the open of the candle prior to the gap up. So this is a rally base rally. So my open would go about right there. Now I'll draw my demand zone from the open of the bearish candle prior to the gap up, like that. And again, we get the massive move up, and you get the sell back to the origin right here to demand into the rally base rally imbalance, and then price takes off. So I'm going to predict a move here just so you guys can see whenever I go back to it, just to refer to my video, that there is another rally base rally imbalance here. You get a rally base. Sorry. You get the rally, the base, and the rally, and that comes from this level right here. You see the structure? I draw it from the open. You see price rallied and it based here. You see, look at this little like consolidation period that didn't last very long. So here's the structure, rally base rally. I take the open of the bearish candle prior to the gap up, and I would draw my level from here. Oops, wrong box. And I would draw it from here and extend it out. Price likes to make back to the origin of moves. So this level right here should present a nice bounce for Snap in the near future. Drop, base, drop. So we already have two levels of